Many of you were here a week ago when we had the workshop on writing a successful business plan. How many of you were? Show of hands. Excellent. Actually, more to the point, who's here that was not here last week, that did not attend that session? That's good to know, because I want to make sure I cover a few points again that I covered last week. I'm John Rollins, and I'm a serial entrepreneur. Started my first business a couple of months after I got out of school, and been teaching entrepreneurship here at GW since 2001. I started this business plan competition 5 years ago, so that makes this the 6th annual GW business plan competition this year. So I'm just delighted that we've got a record number of teams in the semifinals this year. The judges, out of the 113 submissions we received, chose 40 to advance to the semifinals, which is a record number. We've never had 40 before, and it's all based on quality. So it reflects the work that you all have done. And but now the odds get tougher, because in the next round we're going to cut from 40 down to about 10. So you got to write a good 15-page plus appendices, 15-page business plan to make it to the finals. So last week we covered the entire business plan, and as you recall, I emphasized 3 of the sections that I thought were really important. The one on strategy, which covers your competitors and your competitive advantage. The second one we talked about at greater length than the others was the marketing plan, another one I consider important. But the third one is the financial projection section. And it seemed from the feedback that we get every year, there are a lot of people interested in learning more about financials. And I think that's a reflection of the fact that this is a campus-wide competition. And very few of the people who enter the competition are finance majors or accounting majors. And so I want to sort of help balance things out by spending some extra time talking about financials. So everybody can be on more of an equal footing going into it. Feel free to interrupt me with questions as we go along. I saw a hand here. Is there a question yet?
You mentioned 15 pages.
15 pages.
Plus red light. Between 15 and 20? Or?
We can have up to 5 pages of appendices. So if you go to the maximum on the 15 and the maximum on the 5, you're at 20.
All right.
That's right. You don't have to go to the maximum, but actually I do encourage you to go to the maximum on the 15. We talked about that last week. There are 7 sections in the business plan, and so my advice was write 2 pages on each one, and then whichever one is your strength of your team, where you've really got the most to say about something that's really great, write an extra page in that section. Question back here.
You mentioned that as it goes from 40 to 10, is it going to be 5 from like the social track and 5 from the for-profit?
We don't know.
Okay.
It's all based on quality.
Okay.
We'll see. Yeah, and we don't even know for sure it's 10, but that seems like about the right number to me. But last year it was 8, but we didn't have the social entrepreneurship track, so that's the reason I'm thinking it feels about right to go up to 10. Well, let's see. So with the 2 new social entrepreneurship prizes that we were just talking about, $7,500 for the best nonprofit social venture and $7,500 for the best for-profit social venture, it brings the total up to $101,000. Last year we actually had a total of $63,000, so we had a good year of growth in terms of the cash prize money. Of course, there are non-cash prizes also. Okay, thank you. Sam's a great assistant. The other 8 prizes are listed here. If you add up the 15,000 on the last screen with what's on this screen, you get 101,000. And the final round judges are really the key to your success. You won't know who those are until the actual day. But they choose the winners of 9 of the 10 prizes. Can you figure out which ones the judges don't choose? Audience Choice Award, yeah. And that one is selected by popular Twitter voting. Last year we had voters from 10 countries around the world, because we stream it live from our website all day. It'll be April 11th this year. And while it's being streamed, we've got people watching all around the world. I think there were 75 people in the room, all of whom were eligible to vote. I don't know how many voted, but we had about 330-some votes cast, unique Twitter votes. Can't vote more than once. So it is watched all across the country and around the world. So the 7-section business plan culminates with the financial projections, and that's what we're going to dig in on tonight. Obviously, you don't want to miss the important details here. You can be disqualified if you go over your font size, or under your font size, I should say. I guess we wouldn't disqualify so it had bigger font, but the idea is to not get really small font so you don't have a competitive advantage. It's due by March 3rd, and by 9 a.m. on March 18th, we'll announce the winners on the website. Any questions about that material so far? Yeah.
But just really quickly, for the first through fourth place prize money, that doesn't matter if it's an undergraduate or a graduate team.
No, it could be anybody. It could be social entrepreneurship, it could be non-social, it could be whatever, you know, just the very best one in the eyes of the judges, ranked 1 through 4. Okay, so this is what we're going to focus on tonight are the financial projections and how you generate them. And I'm going to end up at the end of the evening with a live model, really an integrated financial model that I'm going to make available to everybody here. We're going to have it on the website. In fact, it already is on the website. We put it up, so you could use that to help generate your financial projections going forward. This is really a review of a couple of slides we went over last week for those of you that weren't here. So why do you need a financial plan if you're just starting a new business? What is the purpose of a financial plan? Who wants to answer that for us? Right here.
Kind of gives you goals and kind of allows you to think through your processes.
Right. It becomes a yardstick, gives you goals, you can measure your progress against the goals. What are some other reasons why you need to have a financial plan?
If you're seeking investment, it gives the investors an idea of how ambitious you are and how realistic you are.
Exactly. And a reason why they would want to invest. Absolutely. In fact, the whole business plan has that purpose, as we talked about last week. Any other reasons in the back?
It could, like to that same point, it could show like what type of strategy you're going for. Like you mentioned last week about like the lowest cost possible, or something to that effect, to see if like with their past experience that was successful, if they want to invest in that type of
That's right.
idea from that.
Any other ideas? Here.
See if it's viable.
To
If
see
you're
if-
going to get more money than you're going to lose, or that you're going to put into it.
Gonna see if it really works. And obviously, you really want to go through a careful set of projections so you know what the burn rate is. In other words, how much cash you're going to burn so you know how much capital to raise. Hopefully plus a cushion. And we'll talk about that cushion tonight. So it helps you figure out the answer to the question about not only whether you're going to make any money, which is the point here, but also whether or not you're going to raise enough capital to make it all worthwhile. So 3 years of income statements, 3 years of cash flow. We're going to spend some time showing how you can go from an income statement to a cash flow statement. We're also going to talk about the capital required. This is another review slide from last time. The income statement, which is in a nonprofit organization called a statement of activities, is one of these. This is based on a hypothetical business that starts after commencement next May and has sales being generated. I think the battery's dead. Pointer. Has sales being generated of $2,000 the first month, with an increase of $2,000 each month after that through the end of the year. You're up to $16,000 in sales revenue. Has cost of goods sold, which is generally shown as the first line of your expenses, which are 50% in this case of the sales. So if you're selling widgets, the cost to you to buy the widgets is on the cost of goods sold line. Fixed costs include stuff like rent, something you just pay every month the same if you're leasing equipment or paying your utility bill or your phone bill, your internet bill, whatever. Depreciation, which is computed based on 1/36 in this case. We did a 36-month or 3-year depreciation schedule. So this is $9,000 worth of equipment bought up front. It's depreciated over 36 months or $250 a month. And then salaries and wages I've put as a fixed at $4,000. Going up in year 2 and year 3. This is year 2, 2015, year 3, 2016. It's just a simplified income statement to demonstrate sort of how they work and what it's about. But the rules that are followed in building this income statement are the rules of GAAP, G-A-A-P. Who remembers what GAAP stands for?
General Accepted Accounting Principles.
Generally Accepted Accounting Principles. Very good. And that's really what's called by many people accrual accounting versus cash accounting. This is not cash. This is accrual or GAAP accounting. And that's why you see stuff like depreciation. Because obviously you bought that equipment for $9,000 up front. Whatever it is, computer servers, furniture, stuff for your office for $9,000, but you have to depreciate it over what they call a useful life, in this case 36 months. So this is GAAP accounting. And you subtract the expenses from the income, you get the profit or loss. If it's a loss, you put it in parentheses. Excel makes it red, which is kind of nice. Shows your losses in red and your profits in black. You know, when you're in the black or in the red, Excel is very sophisticated about that. Your break even is in October, right here. So we have a total loss for the year of $6,000 for 2014. And that's not cash, really. That's GAAP, or accrual accounting. Does anybody remember from last week once we added up all the other cash items, like buying the equipment up front and everything else, how much cash this actually really burns in that first year? 6,000 is really not the right answer, even though it's the GAAP answer. Anybody remember what the negative cash flow was in the first year?
Was it 36?
35,000. You're very close. Yeah, 35,000. And we'll show you on the next slide how you get to that. But the point is, there's a big difference between cash and accrual or GAAP accounting. And it's important to understand that because your income statements being prepared by your accountant or whoever will probably do it this way. But you're going to also want to look at the cash flow statement, which is different. So we're going to go next to the cash flow statement. We're going to show how you can jump from this to the cash flow and understand mentally the differences between the two. The differences are highlighted in yellow. If you made sales in May and June of $2,000 and $4,000, which we had on the previous slide, but you don't collect the money from your customer for 2 months, cash doesn't come in until $2,000 in July and $4,000 in August. So it's delayed by 2 months based on the assumptions we put in here to demonstrate the difference between making a sale for accrual purposes, and Gaap requires that you show that at 2,000 in May when you sold the product. But if you sold it to a business that's slow paying their bills to you, a B2B transaction, you may not get it until July, 2 months later. That's what's called a timing difference. Cost of goods sold also has a timing difference, but that's in your favor because you're going to probably not pay your supplier of the raw materials that you make your widget out of until at least 1 month after you bought them and sold the widget to your customer. So I've delayed that 1 month. But that's good because it means you don't have to pay your bill the instant you take delivery on the product. You put it on a credit card and pay it the next month. Or, in fact, we'll talk later about how you can finance a business by working deals with your suppliers, with your vendors, and getting better terms from them to not have to pay as quickly. And then so both of these are timing differences. This is not a timing difference. It's just a difference in philosophy. You had to pay the $9,000 up front for the computers and the furniture, whatever you bought when you set up your office, and depreciated it over 36 months at $250 a month. But from a cash point of view, it's zero. And then the other half of that transaction is down here, where you actually in May paid $3,000 for purchase of furniture, phones, etc., and $6,000 for computer equipment, systems, internet connectivity, routers, whatever you need for your office. So really, in the first month, you're negative $14,000 on cash, as opposed to, what was it on the previous slide? It was $6,000 for the year, but it was actually for the year here, it's $35,000. That was the number we talked about a minute ago, $35,000. But it's a big hit the first month, $14,000. Then you add another $6,000 here, you're up to 20 negative. Add another $5,000 negative here, 4,000 more, 3, 2, 1. Then you hit 35,000 here, and you break even in December finally. So your cash break even is December, whereas your accrual break even from the previous slide was October. So that's a big difference. So we want you to show 3 years of both the income statement projection and 3 years of a cash flow projection. And these are just guesstimates. Projections, you could be guessing, this is supposed to be your best guess in theory. You may want to privately do a worst case or a best case scenario that's different than this best case estimate, because you may want to have the worst case one to sort of figure out how much capital you really need in a worst case scenario. We'll talk about that in a few minutes. Question in the back.
I just want to clarify. So, like, for fixed costs, as startups, a lot of times it's kind of hard to estimate these. So, if we do have rent, should we kind of like allocate what part of the rent might be used for an office, or should any of that factor into like our fixed costs when we're a startup? If we're working out of our home.
If you're working out of your home, you would show zero rent during that period, unless you do have actual expenses related to your office being at home beyond what you would normally pay at home for your utilities and things like that. If for example, you had to have a special internet drop put in with a higher speed or something that you would not normally have in your home, then you should add that as a business cost and pay for that internet connectivity out of your business as a business expense. But you don't really need to fudge any expenses. Just take the real ones that you have. And it's smart to start it in your home, absolutely, because you have much lower costs. But in this example, we were assuming that there was rent from the beginning and salaries from the beginning. In fact, last week we talked about how in the first few months, or maybe a year, you won't even pay yourself a salary. You might be taking equity, stock, in return for your time that you're putting in running the business that you're founding. And as a result, your salary line could be zero, but then you would want to issue stock, okay, which dilutes the ownership and gives it to you, dilutes any other shareholder, because you're the one doing the work in the office. Another question.
In regards to the investing activities and the purchasing furniture, do you want us to detail out what actually pieces of equipment that we'll need for, or could we just give a broad statement just as you have?
I think at this point broad statements are okay. If it's a big number, you might want to detail it.
Right.
If it's 3,000 or 6,000, I wouldn't worry about it. In regards to the corporation itself, 2015, you're going to have a whole operating activities, just like the sheet itself. That's right.
It's not going to be just 15, all the gross numbers, and 16, all the gross numbers.
No,
It's going to be.
You could get by with this with the judges, I think. You could, by aggregating all your months in year 2 and year 3 into a single column. But if there's anything that is material that's going on in either year that's changing, you should spell it out so the judges will understand why they're seeing what they're seeing. This one's so simple. It's all pretty much straight line growth. And so I just put them in a single column because I think it doesn't require more detail in this simple case. But if anything complicated is going on, definitely explain it. Hey, thank you. Any questions on the cash flow? This is a lot to digest at once. Yeah, in the back?
Yeah, I understand the case and point if you have an office in the home. How about if you own an office building and you have to start a business in that building? Can you show minimum or zero?
Yeah. Who owns the building?
I do.
It's yours. But you're donating the use of it to the business, to the and your business is a nonprofit. So you're getting like a tax deduction for donating it to the business. So that's very generous. That's good. So you really would show zero. You're right. But you personally would want to talk to your accountant about getting a tax deduction for your donation of the use of the building, assuming the nonprofit is a 501c3 and is.
It isn't a nonprofit. It is a profit.
I'm sorry?
It is for profit.
A for-profit. Okay, so it's not tax deductible. It's a gift. You want to talk to your accountant and find out how you can personally take advantage of that situation, if there is a way. But if you're donating it to the business, then the business pays nothing and they show zero rent. You would want to get stock in return. Your accountant could probably advise you on how to structure that deal. One more.
So for companies who are using infrastructure as a service, so looking at cloud computing to try to answer the questions of, instead of you're doing this very large investment at the front to buy servers, workstation, especially if you have a web base,
right?
But going towards infrastructure as a service where you're not really having to worry about depreciation of value because you're paying for that service which they're responsible for. Would that look weird if you had a show of saying, okay, we don't see any depreciation, but making notes like we're using infrastructure as a service, but the initial investment would be, if you're looking at it, growth periods of the initial paying rent for however rack space or servers or all the tools that you use, and that would kind of fluctuate. Would you just tie that in more the month-to-month cost?
Yeah, because if you're going to a company like Rackspace Hosting, somebody like that, to get your server time from, you just show it as a month-to-month expense, and you wouldn't really need to show anything up front. At least that company, great company, RAX on the NASDAQ, they just charge you month-to-month for the use of the servers. Yeah. Okay, if there are no other questions, let me go on. Test out the clicker here. It works. Hey, thank you, Sam. Until the back comes on. Okay, the next question, and one of the reasons why you do these financial models in the beginning is to determine how much capital you need to raise. So, and that's number 3 on that list of must-haves in the financial section, is the amount of capital required. So the question is, with that model, $35,000 total negative cash flow until you break even in December, how much capital should you raise for your business? And there's really not a right answer to this question, but it's the big question you need to ask yourself. Once you determine what the cash flow, negative cash flow, assuming there is negative cash flow, most businesses do have startup negative cash flow. How much capital do you then need to raise so that you can also have a cushion built in? And I said last week, it's really a function of the volatility of your business and what the risk is, best case, worst case, because you want to have enough cash to cover your worst case, so that you don't have to shut down the business just because the volatility fluctuates beyond your initial projection and you have to shut it down because you don't have any cash to pay the bills. And I also mentioned last week that an entrepreneurship professor of mine, when I was getting my MBA, taking a course like the one I teach now, suggested if you don't have any better way to estimate it, use the 2x formula. So if it looks like it's going to be a $35,000 negative cash flow, raise $70,000 in capital. That way you've got a cushion of 100% in terms of the fluctuation or the volatility. Now there may be businesses that are service-based that are much more, much less volatile. And so you wouldn't need to go to 2x. I was starting, my first business was an IT business. And so I did end up raising twice what I thought I would need. And it's a good thing I did because I ran through, before I broke even, about 90% of the cash I'd raised. But the 2x formula worked for me. I didn't go over the amount of cash I'd raised. But if I'd just done 1x or 1.5x, I would have been in trouble. Yes?
As we figure out the capital and the sources, is risk going to be considered at all, whether you're using equity or debt, or like is that going to be consideration when it comes to judging the viability of the business?
Well, we're going to be talking about debt in a few minutes. In fact, our special guest tonight is from Capital One Bank. As you know, Capital One Bank is one of our gold sponsors of the business plan competition, and I'll be introducing John Tucker in a few minutes to talk about debt. But no, in terms of cash is cash on the income statement or the financial statements, but you can get it from either of two sources, equity or debt. And the largest single source of debt capital, banks. It's where the money is. Or alternative lenders. There are alternative lenders that he's going to talk about as well. But so at this point, we don't have to worry about what the source is. We'll get to that next. In fact, that's a good segue into the sources of capital. And generally, you want to start with yourself, your family, second, and then angel investors third. But the more you can get it done through these four sources here I'm going to talk about next, the more equity you can retain for yourself. May not be possible to raise enough equity from yourself. I couldn't do that with my first startup because I just paid for my MBA and I didn't have any money, basically. So I had to go to friends and family and one or two small angels to raise what I needed for my first startup. But if you can do it from savings, investments, credit cards, they say, are the #1 source of startup capital for new businesses. Maybe your Capital One credit card, whatever. But be careful because they have high interest rates. But you know, people do it. It's readily available, as you guys know. I mean, when you're in college, you're in the university, you're getting credit card solicitations all the time, so you know it's available to you. And they're really, the bank is the #1 source of loans and debt capital. Really, credit cards are a form of debt, like loans. These two are debt, okay? And all the rest are really equity that we're going to talk about here. You're going to, if you put money in out of your investments or savings accounts, you get stock in return for that, and that means it's equity. I mentioned a few minutes ago the concept of bootstrapping, where you structure your business so that your vendors or your customers are really helping finance your startup. And that's what's called bootstrap financing, where you don't have to go out and sell stock or get a loan, either one. I read somewhere that gift cards in circulation in the United States are like $20 billion now, some huge number like that. And that's basically an interest-free loan you've just received from the customers that bought gift cards and didn't cash them in right away. So all those billions of dollars out there are basically interest-free loans to the businesses, and some of them may get lost and never get spent. So that's your customer financing you. The other one I mentioned before is your vendor financing you. So on your cost of goods sold line, where you're buying products from a vendor, it would certainly behoove you to negotiate good payment terms with your vendor. By good, I mean long. The longer the better. If you can get 60 days or 90 days or whatever, a longer period of time to pay your bills is good, because that means less capital you have to raise up front when you're starting your business. Anybody think of any other bootstrap financing methods other than the two I just mentioned? Yeah.
Subscriptions. So
Yeah.
getting our, like in our business that we were gonna do, have the counties that we're planning to be in it subscribe as future, and so have them start the service 6 months or a year from the time where we sign the contract. Now that way we have that flow.
Sure. Subscriber model's a good one. In fact, my fourth startup used that model. We were selling online educational video streaming classes for professionals that needed continuing education, doctors, lawyers, engineers, whoever, and they would pay up front on their credit card for a course that they would take over 6 months. So we got the cash in month 1 at the beginning, and then we incurred the cost over the next 6 months. So that was sort of the same, like a subscription model. That's another example?
Yes, in a kind of an indirect way, but like, again, with the infrastructure as a service, certain resources you need, such as lawyers, getting your plans out and such. There's our experience, we've been able to talk to a few different organizations and companies that have said, hey, we kind of like your direction you're going, and we'll give you this many months of services with the expectation that once this is starting to get its feet under itself, would that be considered because you're delaying any of the costs, but you're not putting a loan on it, but they feel kind of putting an investment for future business and growth with your venture?
Wonderful. You're thinking the right way. And for those of you that are starting social ventures, be sure to take advantage of whatever you can to get the same kind of interest from your constituents. If you're a nonprofit, that might mean grants, donations, all kinds of things that would help leverage your cash and get the business going up front that way. Another idea?
What do you think about crowdsourcing?
Oh, wonderful, yeah. If you have to have something for them to, in other words,
Like
yeah,
a product or something like
a
that.
product or something
Pre-sale
that they're bidding on. Absolutely, that's a great source nowadays.
Because also you're not giving up any equity or anything like that.
Yeah, well, the law isn't quite in place yet for you to raise capital through crowdsourcing unless you're going to only very wealthy investors. But it won't be long until they fully implement the law that was passed last year to enable you to raise capital online through crowdfunding.
John?
Yeah.
We just received an update that our snowpocalypse warning goes into effect at 6:30 tonight. That affects our reputation.
Good.
All cars will be ticketed and towed away starting at 6:30.
Okay.
In case you have a car sitting out there, it may be towed away.
Is that for DC or Maryland or Virginia? Or
DC.
DC? So they're going to start enforcing the snow emergency routes in case you're parked in one of those right now.
I got 29 minutes.
Like most of the streets.
Is 23rd just on the outbound side, on the west side, or is it on the east side also? Because you can't park on the west, you can't park on the outbound side now during rush hour until 6:30 anyway. So it's academic. But if they did the east side, a lot of people would be in trouble.
Where are you parking?
Unfortunately, I'm not there. Thank you, Melanie. Yeah.
And is it appropriate to raise money from some website, some platform like Kickstarter?
Absolutely. That's a good example of crowdsourcing, Kickstarter. But you need a product or something you're selling or doing to do a Kickstarter campaign. But that's a great idea.
That's a source of equity.
Kickstarter is not used for raising equity. Not yet. The law isn't in place yet to enable you to do that. You're usually doing a product or promotion or something like that.
I think you actually can. I mean, some people, for the highest perks, that you can place it as such. I mean, most people don't because you can get a free pass as it, but if you wanted to, you can give away some of your company if you want to as a perk, but most people don't.
Oh, you could give it away.
Yeah.
Yeah, but you can't sell it. You can't sell shares of stock because at this point it's only for accredited investors. And Kickstarter is not limited to accredited investors. Friends and family, great place to turn. The reason I said be careful is you've probably read stories about families that have been divided over business failures, divorces, all kinds of family issues. So you don't want to accept money if it's going to put your relationship with your brother-in-law or your uncle at risk. So you want to be careful there. In fact, I raised, in my first start, I put some money from a couple of family members, and I offered a couple of years later to all the shareholders to buy back the shares because we were making money at that point. We had some money in the bank, and so we'd sold them for $1 a share, so I offered to buy them back for $2 a share a couple of years later. And a few people did, which was a signal that, wow, these people probably really, shouldn't have put the money in the first place. They want to get it back that quickly. But I was happy to give it back because that increases the value per share for everybody that's remaining. In fact, I ended up doing a whole series of those buyback offers, what are called tender offers, so that people could sell their shares if they wanted to at any point in time. It's a good way to sort of stay on good terms with your friends and family and people that have invested. The angel investors could afford to stay in because they're in it for the long haul to try and really make some money, get a return on investment, ROI out of it. In fact, in your presentations to investor groups or individual investors, you want to talk about the ROI that an investor would get on their money that they put into the business over a period of years that you estimate they may remain an investor in the business before they cash out. Any questions on the sources of capital? Yeah.
So we have angel investors and they want, so you are the CEO, you're the owner, and then they want you out of the company.
The question is, could the investors force you out as the CEO and founder? And generally, the answer is no, generally. However, I have heard cases where enough equity was sold to a venture capitalist. A lot of people refer to these guys as vulture capitalists for this reason. The venture capitalist wants to control the company. And so they try to get to a point where they can, if necessary, in their opinion, fire the CEO. So you got to be careful of those kinds of investors. Generally, angel investors, on the other hand, are going to want to work with you and they want to be on your board and help you solve problems. And they're probably investing because they like your business plan and they like your mission statement and what your product or service is going to do. It's in an area of, that they're interested in, and that's why they're investing in it. In fact, they may have made money with a similar investment themselves earlier in their life, and they're coming back to invest in your business now because it's something they understand and want to help you so you can do better. Yeah.
Can you explain how a convertible note works with angel investors?
Yeah, a lot of people use convertible notes. The question is, how does a convertible note work? And a convertible note will convert into shares at some future date, but it's really technically a note or debt on the day that you give it to the person in return for their money. You issue a note to them, and it may say have an interest rate or something in it, but it's in fact the popular way nowadays is to have it convert at whatever rate the shares are priced at in the next round of investment that's sold to outside investors. So you're making a loan up front. You don't know how many shares you're going to get until that round is defined, and so it's a little bit of a gamble on, you don't know how many shares or what percentage of the business you're going to own once you've converted your note into equity. But it's a convenient way to get money up front before the round is actually put in place, the investment round. So this is what we saw before. Operating activities are basically, as the term implies, the operations of the business, and that comes from the income statement. Investing activities are what you're buying in the way of capital equipment. And then the third area, the new one, are the financing activities. And those three together make up the cash flow statement. Cash flow projection in this case. So when we add these, we're trying to figure out a way to raise at least $35,000, and in this case, I've made it come out to $70,000 following that 2x formula I learned from my professor. I've got $25,000 coming from prizes in the GW Business Plan competition, some combination like second place is $15,000, best undergraduate is $10,000. That ends up to 25. You can get up to 25 a number of different ways with different prizes you're winning. And then the founders, the team members, you guys, they're putting in $10,000, and they're getting a low price per share because it's founder stock, so they actually own a higher percentage than you would expect if you did the math. And then the outside investors, they're raising $25,000. So this is just a way to get to 70. 25 plus 10 plus 25, that's 60. And then I have $10,000 of a bank loan. And probably wouldn't be able to get a bank loan when you're a brand new company over here. But once you've developed, you've got receivables here of $10,000. Actually, 10,000, yeah, the receivables would be 2 months worth because we have a 2-month lag on the collecting of the cash. So at this point, you might have $20,000 in receivables because you're doing $10,000 a month in sales. And so 2 months lag would give you $20,000 of receivables. The bank might then be willing to loan you using that receivable as collateral, say $10,000 on a line of credit. So you come out with enough that you still have your 35, by getting 70,000 of capital, and you only needed 35, you've got 35,000 in the bank at this point, if you're right on target with where your expenses and revenue are projected to be. And obviously the reason you raised to 70 is that you could be off on some of these, and you may burn through a lot of that 35, as I did with my first startup, before you get to a break-even point. Question?
So would you say for, like, the 2x rule or whatever, that the only way you would really do that would be through stock options versus, I'm thinking, especially if you're a startup, unless you're a serial entrepreneur with proven success, or you put the house up, or you have some valid collateral that somebody's not going to just write a real hefty check for you, saying like, you know, oh yeah, I trust you with 100 grand, saying that, you know, that's twice the 50 grand that you need. I mean, I don't know. I mean, I'm just thinking of like, you know, I think you talked about even last week of like, you know, you might think that your projections are realistic, but if you're in a volatile type business, or like say service business or whatever, or say I came out of the hospitality program, hospitality pre 9/11, you can predict that, and then it goes all the heck. You can't predict that.
I think the easy answer to your question is raise it as equity. Then you don't have to worry about putting your house up as collateral or co-signing on a note, which is a common thing, by the way, for an entrepreneur to personally co-sign on a bank loan or any loan to his business, because they want to make sure they have collateral. And I certainly did that many times with my businesses, but I always made sure that ahead of my personal assets were the company's accounts receivable and the company's assets. And here you are at $10,000 on a bank line of credit, but I got 2 months of receivables, the way this is modeled. So the company has $20,000 owed to it from receivables. So the bank would go after that first before they went after my personal assets, my home or something. So you're right to be wary about that. But if you raise equity capital, the problem goes away because you're not at risk. Question back here. The question is, can the investors force you out as the CEO and founder? And generally, the answer is no, generally. However, I have heard cases where enough equity was sold to a venture capitalist, and a lot of people refer to these guys as vulture capitalists for this reason. The venture capitalist wants to control the company. And so they try to get to a point where they can, if necessary, in their opinion, fire the CEO. So you got to be careful of those kinds of investors. Generally, angel investors, on the other hand, are going to want to work with you, and they want to be on your board and help you solve problems. And they're probably investing because they like your business plan, and they like your mission statement and what your product or service is going to do. It's in an area that they're interested in, and that's why they're investing in it. In fact, they may have made money with a similar investment themselves earlier in their life, and they're coming back to invest in your business now because it's something they understand and want to help you so you can do better. Yeah.
Can you explain how a convertible note works with angel investors?
Yeah, a lot of people use convertible notes. The question is, how does a convertible note work? And a convertible note will convert into shares at some future date, but it's really technically a note or debt on the day that you give it to the person in return for their money. You issue a note to them, and it may say have an interest rate or something in it, but it's in fact the popular way nowadays is to have it convert at whatever rate the shares are priced at in the next round of investment that's sold to outside investors. So you're making a loan up front, and you don't know how many shares you're going to get until that round is defined. And it's a little bit of a gamble on, you don't know how many shares or what percentage of the business you're going to own once you've converted your note into equity. But it's a convenient way to get money up front before the round is actually put in place, the investment round. So this is what we saw before. Operating activities are basically, as the term implies, the operations of the business, and that comes from the income statement. Investing activities are what you're buying in the way of capital equipment. And then the third area, the new one, are the financing activities. And those three together make up the cash flow statement. Cash flow projection in this case. So when we add these, we're trying to figure out a way to raise at least $35,000, and in this case, I made it come out to $70,000 following that 2x formula I learned from my professor. I've got $25,000 coming from prizes in the GW Business Plan competition, some combination like second place is $15,000, best undergraduate is $10,000. That adds up to 25. You can get up to 25 a number of different ways with different prizes you're winning. And then the founders, the team members, you guys, they're putting in $10,000, and they're getting a low price per share because it's founder stock, so they actually own a higher percentage than you would expect if you did the math. And then the outside investors, they're raising $25,000. So this is just a way to get to 70. 25 plus 10 plus 25, that's 60. And then I have $10,000 of a bank loan. And probably wouldn't be able to get a bank loan when you're a brand new company over here. But once you've developed, you've got receivables here of $10,000. Actually, 10,000 months, yeah. The receivables would be 2 months worth because we have a 2-month lag on the collecting of the cash. So at this point, you might have 20,000 in receivables because you're doing 10,000 a month in sales. And so 2 months lag would give you $20,000 of receivables. The bank might then be willing to loan you using that receivable as collateral, say $10,000 on a line of credit. So you come out with enough that you still have your 35, by getting 70,000 of capital, and you only needed 35, you've got 35,000 in the bank at this point, if you're right on target with where your expenses and revenue are projected to be. And obviously the reason you raised 70 is that you could be off on some of these, and you may burn through a lot of that 35, as I did with my first startup, before you get to a break-even point. Question?
So would you say for, like, the 2x rule or whatever, that the only way you really do that would be through stock options versus, I'm thinking, especially if you're a startup, unless you're a serial entrepreneur with proven success, or you put the house up, or you have some valid collateral that somebody's not going to just write a real hefty check for you saying like, oh yeah, I trust you with 100 grand, saying that, that's twice the 50 grand that you need. I don't know, I'm just thinking of like, I think you talked about even last week of like, you might think that your projections are realistic, but if you're in the volatile type business or like say service business or whatever, or say I came out of the hospitality program, hospitality pre-9/11, you can predict that and then it goes all the heck. You can't predict that.
I think the easy answer to your question is raise it as equity. Then you don't have to worry about putting your house up as collateral or co-signing on a note, which is a common thing, by the way, for an entrepreneur to personally co-sign on a bank loan or any loan to his business, because they want to make sure they have collateral. And I certainly did that many times with my businesses, but I always made sure that ahead of my personal assets were the company's accounts receivable and the company's assets. And here you borrowed $10,000 on a bank line of credit, but I got 2 months of receivables, the way this is modeled. So the company has $20,000 owed to it from receivables. So the bank would go after that first before they went after my personal assets, my home or something.
Yeah.
So you're right to be wary about that. But if you raise equity capital, the problem goes away because you're not at risk. Question back here.
Yes. So for the winnings from the GW Biz Plans for this competition.
Right.
So if we're in multiple, if we think we have multiple undergraduate, social venture, and for top prize, and we think we have a good shot at doing that, adding all that up, that wouldn't look like from a winning an unrealistic projection saying, hey, we can take a good shot.
No.
This is where we're going to go.
with this and with this.
Put it out there. Show the judges you have a lot of self-confidence.
Okay.
Obviously, if you don't win, then you got to fall back and get it somewhere else. But there's absolutely nothing wrong. In fact, I think that's a good strategy. Show some self-confidence that some of the money's going to come from GW. And as you know, the money from GW is not an equity investment in your business. It's a gift, a grant from GW. So it's not in return for capital stock, which these are. This is just free money. I want to pause for a minute and introduce John Tucker. I mentioned his name before. He's a business banker with Capital One Bank, and he's going to talk to us about the banker's perspective on this whole thing. Lending from a banker's viewpoint. John, come on up here. Let's welcome him. I did promise that I would show you the financial projection model, and so if you're not interested, feel free to leave. But I want to take a few minutes to do that, since I said I would, and where to find it on our website so that you can use it. Make a note of the URL that's at the top of this slide. It's on our website, gwbizplan.com/workshop_slides. And that's the screen where we have all the workshop slides available for all the past workshops we've done for this entire year. And you'll see indented under the name of this workshop from last year, the words financial template. And if you click on that, you can download this Excel tool, which helps you with your forecasting, which I'm going to bring up the live version of now instead of this PowerPoint slide. You can see it's an Excel-looking spreadsheet. There are three sections. The top section between the top blue lines has to do with revenue, and it automatically fills in line 16 with revenue, and I'll demo this in just a minute with the total revenue from the top section. Then it converts it into a cash flow statement, and then actually gives you a balance sheet at the bottom. It's very, very simple to use. If the name of your business is XYZ Corp, you can put that at the top. I don't type very well. And then I'd recommend you go down next and put in, you'll notice that these are columns. B is the current period before you start your business. And then year 1, year 2, year 3. In fact, I could start by just eliminating, since we're only going to do 3-year projections, we can delete that column.
There's 40 total teams.
And that column. And that column. Just do a 3-year projection. Simplify, but I recommend you start by going down in this column B and filling in how much cash you're putting in at the beginning from investors, from yourself, whatever the sources are. And you notice immediately, I just typed one number and it populated all these other cells on the sheet, because it's really going to build a full model here very easily. I forgot to give myself shares of equity for my 20,000, and it's warning me down here at the bottom that this balance sheet must equal 0, and it's coming out with 20,000 negative. So if I give myself common stock worth $20,000, now I'm in balance down at the bottom, as you can see. So it's really a self-checking model as you go along. In fact, you wouldn't have to give yourself 20,000 in equity. You could say, give me 15,000 of equity and 5,000 of debt. I'm making a loan for 5,000, and you'd still get down to zeros at the bottom, as you can see. So it's kind of a cool model. Then I'd recommend you go up to the top, and it has room for up to 4 different types of products that you're selling. And it's you can put it in as a unit price. Let's say I'm going to sell my product for $1,000. I put that in. You notice it automatically inflated it by 5% a year going out. You can change that growth rate. Instead of 1.05, you could change that to something else. You could say that I'm going to grow at a much faster rate. Just change the formula in there. Obviously 1.05 for now. And that's going to be based on, that's the unit price, based on, say, 25 sales my first year. I like to grow 50 sales the second year and 100 sales the third year. So already you can see I've got, just from product one, I've got 110,000 in my sales forecast. It's building the whole income statement down here, the sales revenue, cost of goods sold, and this has a formula in it that's based on 80% being cost of goods sold. I like 50% better. You can change that to whatever it needs to be for your business. You can put in a second product. Let's say you have a premium version of the same thing, but it sells for $1,500 instead of $1,000. And let's say you're only going to sell 20 of those. Boom. It's already done all the math. It's moved it out. I should put in some sales the second year, following my formula of doubling. We'll say we go up to 40 and then 80. So it's just building the whole model here just from a few keystrokes. Now it's going to say, how about paying any wages or salaries? And I'm going to say, well, I'm not going to pay myself anything the first year, but the second year, I'm going to take a salary, about 50,000, and then I'm going to bring in somebody else that the next year, and the total salaries are going to be 100,000 this year. Boom, it's done. And you want to put in some G&A, administrative expenses, for rent and stuff like that. Fixed cost is what we called it in the previous model. We were talking earlier. Let's put in 12,000 a year. You take a look, see how we're doing on our bottom line. Whoops, we got a $1,000 loss year one, a $15,800 loss year two, and then a profit in year three. So we said, that $20,000 that we put in the beginning down here wasn't enough to carry us through because our cash balance went negative here. This is in the cash flow statements building. So what do we do to fix that? Well, let's go to maybe some financing activities here and say in addition to the 20,000 we put in up front, let's say we sell another 10,000 of stock, and you can do this iteratively and figure out how much it's going to take. Well, actually, that was enough to turn the cash balance. So it's positive across row 45 here, just by putting in 10,000. But actually, I wanted to spend some of that 10,000 to buy some additional equipment that we needed. So I have investing activities of 5,000. boom, it shows you the rolls. I'm still okay. Positive cash balance going across there. Just a cool little model. And that was all in 5 minutes. And I've still got zeros here, which is good. I haven't made any mistakes. Oh, there's another tab on the spreadsheet. We're on the first tab. If I click on the second tab, Executive Summary. It's a neat little, again, we're not using these 2 years. Take those off. But neat little 3-year summary. Revenue, cost of goods sold, gross profit, operating costs, net operating profit, and it added a new line, cumulative profit. So, or loss. We had losses here, and by the end of the 3rd year, we're up to cumulative loss of $10,525. But those are all just numbers we're taken from the this spreadsheet here. And if you know Excel, obviously you can make this do all kinds of things. You know, they're a little bit different than what the defaults are that are built into the program. And it's yours, no charge. Just download it from the website, the address I just gave you. Question?
Could we possibly tweak this so for those who are subscription based, so if we're saying we're offering our service based off our subscription base other than an actual product,
good model.
We slightly tweak this to show, because it would still be your product with your subscription, whether it's $1,500 per subscription fee or such.
Right.
But it wouldn't. Would we want to try to still use that same 80%, because you do have R&D, you have all these other things that do the statistical analysis or whatever you're needing to build that.
Yeah, you got to figure out what your product's cost of goods sold are to go with that product. This says 80%. The one I showed earlier, I had 50%, whatever it is.
Okay.
Yeah, but yes, this would work well for that. And the fact that you've got 4 different types of products. If you have a web-based product, one of the product lines will be advertising revenue. Another one will be, sales of subscriptions, perhaps, if that's what your web-based product is. So you can have, in fact, you could add more lines in here and have more products, or you could take out a couple if you don't need all 4 and just delete those lines. Excel is very simple to use, and if you haven't used it before, I recommend you learn how to use it, because it's a great tool for any business. Very easy to use and very powerful, as you can see from this.
So the difference that you want to like in the financial part, you do this because it's expense, or you want?
I'd probably put this in one of the appendix pages, because you get up to 5 pages of appendices after your 15-page business plan. You might take that little summary from the second tab, and you can embed that maybe in the body of your business plan in the 2 pages that you write on financial projections out of the 15-page business plan. Or, you following me? So you could summarize it in the actual text of the business plan by putting a little box in there, but then have all the detail like this on a full page in one of the 5 pages of appendix.
So in the 2 pages for the finance part, we don't need to use it for all for the finance. We can use.
It can refer to any. You can have references from anywhere in the 15 pages to appendix pages.
But for the 2 pages of the finance, also the finance part, and I write the marketing plan using all that pages, because if I put this on an appendix, maybe I don't need to write anything.
You still need words to describe what's in the appendix. Words in the financial projection section explaining in English paragraphs, what your financial plan is. And then those words can refer to the appendix for more detail, which is what this is. But you would explain all your products, that product 1 is your advertising revenue, and product 2 is this blah, blah, blah. You want to make sure it's very clear to the reader, but then they can flip back to the appendix to see the actual Excel spreadsheet.
Like a general thing for the business plan, if you have things in your appendix, like any good paper, don't just say, and there's some really key insight, go see the appendix. No, that doesn't apply. You have to go say in English, what is the insight, but if you want more detail, then go do it.
If you want to get credit for it, you got to explain it right there in words, in the body of the 15 pages. Very good advice. Yeah.
So basically the appendix is showing your work behind the math.
Exactly. Backup. It's your backup detail.
That was, I guess, along with that, because I know that I'll have something affecting wages. So you put that in the appendix explaining like why you wouldn't be taking any kind of wages out for 2 years. Instead of
That'd be fine. That'd be fine, because it might be a distraction to get into that minutia in the body of the business plan itself. You've got to make those kinds of calls in terms of what you put where. And if it's just backup support, throw it in an appendix page. But refer to it in the text so that when they finish reading it, assuming they're flipping back whenever you say, this is in the appendix, and they flip and, oh yeah, it's there, they will have flipped back and seen everything because you will have referenced everything in the appendix.
versus like if you're anticipating rolling stuff out, like only, like the first product goes out in year 1, and then year 2 you roll out the next stage or something like that. That goes in the main financial plan in the business plan.
Yeah, and it would be supported by showing a new product with zeros in year 1. Product 2 would have zeros instead of 1,500 for 20 sales, and it would just start in year 2.
Okay.
Yeah.
I'd say just pretend like those appendices aren't there. So have enough words to say what you really need to say, and that's just extra support to back it up. So that's a good way to judge what goes in there.
This generates a balance sheet down at the bottom, which we do not require. It just happens to be part of the model. This balance sheet would be the first thing the Capital One Bank would look at. They want to, as he mentioned, he wanted to see if, you know, how much, what are your receivables out here for collateral, your cash and your receivables. First thing he's going to look at, see how you're going to pay back the loan, see what the balance sheet looks like. And he was saying about the ratio between liabilities and owner's equity. Total equity out here is $11,579, which is added to the liabilities of $14,000. He said he'd like to see these in a 1-to-1 ratio ideally, but you could go as far as having, I think he said 75% in liabilities and 25% in equity, but that was as far as they would go. So this gives you a lot of extra information to help you deal with people like your banker. But it's also good for you to know too. You know, how far are your liabilities going? And a balance sheet, those of you who haven't seen it before, it's very simple. The total assets equal the total of liabilities and owner's equity combined. So this is all your assets, all the good stuff. Your liabilities add up to the 14,417, okay, which means that you've actually got owner's equity of this much. You and the other owners. Numbers. Other questions? Any points anybody wants to raise? I've got one more item. For those of you who may still be somewhat perplexed and need future support, we have a resource here in the School of Business called the Mba Association. And Richard McConkey,
he had to step out the class.
He had to step out? That's right, he was sitting right next to you, wasn't he? Richard is in that Mba Association. Is he the president this year?
No.
No, but he's active in the association, and he's also in the Venture Capital Private Equity Club, which Sam
He is the president.
is running. So he's a financial guy, and I know that there are a lot of people in that Mba Association that hopefully we can tap into if you guys need additional support. Since he stepped out, I was going to ask him for his email address.
So,
since
Go ahead,
since he stepped out, I think the best course of action would be to email the standard bizplan@gwu.edu email address with interest, and I will make sure it gets over his way, so that he can then maybe put the list together and search out people that would be interested in helping.
But we do want to help you if you're still stumped and you need additional help. As I said at the beginning of the session, there aren't many finance majors or accounting majors here, and so we understand that this is a learning opportunity, and we want to help you do that. One more question.
So for the comparison, to make sure that we say these are our best guess, these are things we've looked at into the market and such, so this would be the resource to kind of throw our numbers against and saying, this is what we think is realistic, but can you compare so that we're not shooting off into the left field for...
Yeah, I'm not sure the Mba Association guys can tell you that it's realistic or not realistic, but they can answer questions about the mechanics of how to go about doing the projections. And in the absence of this tool, or if there are aspects of your business that this tool doesn't address, maybe they could address them beyond that. But I wouldn't rely on them necessarily for understanding your business better than you do.
Yeah.
Yeah.
I can help you answer that. I mean, Sam was passing off the torch to Richard last week. There were just 6 of us there. I'm an MBA, and I mean, in the club, I'm going to spend the summer doing private equity. There's a guy who's a CFA in the group, so there's a whole mix of backgrounds. But I think what Richard wanted to throw out was, hey, we might be able to. We can't say, hey, we have the answer, but maybe it's a CFA-related question. We'll tap that guy, or maybe Sam's a finance. We just don't know how we can help, or we want to offer it up.
I'm impressed you've got somebody that's a CFA, and that stands for Chartered Financial Analyst. It's a 3-year program. I mean, it's like getting a PhD in finance or something. It's really quite a credential to have. So.
Yeah, I mean, and that person isn't me, but I mean, he's a fellow MBA. We're in the MBA program, so and Sam, threw the idea out as, hey, it's a great learning tool for MBAs as well, because we don't have a lot of interaction with undergraduates, and a lot of the best ideas are coming out of the undergraduate program. So we're trying to create that bridge between undergrads and MBAs.
Anything else? Great. Well, thank you all for hanging in here in spite of the weather.
Thank you.